fishing off of like.
All right. Good morning, everybody. Mike, this actually feels weird. We've been doing these live, I think, for like 4 months in a row. So we're back to electronic, at least for this one.
Yeah, we can see each other, right? We're in the same building, but sitting at our own desks this time.
All right, so we've got a great agenda today. We've had this one circled for a while. We've actually been talking about having James and Eric from FP Transitions onto this really since we got going. They're a terrific partner and one of the OGs in wealth management M&A. So Eric and James, would you guys take a moment just to introduce yourselves and how you got to where you are, and then we'll kind of dive in.
James, you go first. Yeah, you go ahead.
First. Okay,
yeah, I'll take up all the time.
All right. Of course, James Fisher. I'm our VP of M&A here at FP, one of the partners. How I got here, kind of a longer story. I'll keep it short for purposes of this conversation, but started my life as an attorney for the feds. Did that for a couple of years, was a securities regulator for the state of Oregon, then went into private practice, was doing some securities enforcement work in private practice, but then spent a lot of my time traveling around the country doing mass tort product defect litigation. Happened to meet David Grout Sr. on an airplane coming back from some trial work I was doing in Minneapolis, and we were seated next to each other. And 4 months later, I was over here at FP running M&A and have been here for 8 years at this point. So that's the short story. Of course, longer story there that we can talk about more in person if anyone cares to have that conversation.
Well, it's important to note too, you were seated next to David. You weren't actually flying the plane. You're also a pilot.
I am a pilot. Was not flying the plane in that fact pattern, of course. It was a long day of trial. Not a good time to be flying an airplane after you've spent 8 hours, arguing in front of a judge.
Yeah, securities regulator and pilot. That's the typical career progression for M&A.
Oh, so. Absolutely. Yeah, it's a natural progression. A lot of folks have those credentials.
That's right. Eric, you're up.
Oh, I'm up. Boy, I'm Eric Leeper. I'm the Chief Financial Officer and partner at FP Transitions, partner like James. I've been with FP since 2011. And before that, I came from an investment bank. I was doing equity research on publicly traded companies, mostly in the government space, which is a interesting, as I reflect on that time, interesting space. I'm glad I don't do that anymore, to be frank. But I came to FP as I think I was the 11th or 12th employee at the time, and we're now over high 60s in terms of total headcount. So it's been a fun run. I started off as an analyst, and now I work cross-functionally, both in my management duties and at the executive level, and I work very closely with James on M&A opportunities. So that's kind of my background.
Well, it's amazing to get to talk to the two. First of all, you're two of the brightest people we get to work with. We appreciate your intellect and your thought leadership and all you do for the industry in general. But it's also really interesting because in many ways, when we talk about M&A, FP Transitions was a progenitor. I mean, you guys helped create the world that we live in today. And when we look at Citywire or wealth management or any of the industry rags, and we see transaction, like this all came about in large part because of the work that you guys were doing many years ago. So could you maybe just take a moment? I think this is going to be unusual in that almost everybody that's listening to this probably knows at least something about FP Transitions, but give a little bit of background just about your business and how you've evolved along the way to get to where we are today.
Sure. Yeah. Happy to. It's been a fairly circuitous path, I think. But if you look at it, if you zoom out enough, it looks very intentional. Back in 1999, David Grouse Sr. founded the company. He had two other partners at the time, and the raison d'etre for forming FP at the time was that David was also a securities regulator, not unlike James. And he was tasked with researching a concept of, whether or not a financial services practice, an RIA effectively, or a registered rep, could actually be sold, and did that violate any sort of state or federal statutes that prevent the assignment of these relationships? And the conclusion from that research was no. And David looked at the industry and said, look, there's a real opportunity here. And so it really started out as I would say, kind of an off-the-shelf approach to M&A. And that went on for a period of time. And then it came to the realization that, hey, we should really create a listing service, borrow some things from real estate. That was really the core model that the founding of the company was built on. So this, and that's also important because at that time, transactions, they looked like real estate transactions. They were very transactional in a sense. They were not highly sophisticated. Valuation was even less sophisticated. And so what happened was, it was a very nascent industry, and we learned a lot in those early years. And then in 2006, Brad Bierman came on. He's our current CEO. And he said, well, look, you have all this data about transactions. Can we kind of create this system where we're recirculating that information? Can we do better deals? Can we understand the dynamics of the practice even before they transact? And so what that led into was the creation of a valuation product. Since that time, we've done over 15,000 industry valuations.
Oh my gosh.
Yeah, it's tremendous. And honestly, the biggest benefit from doing all those valuations is the practice management data. So we did valuations for a while. We continued to support M&A. And now all of a sudden we were sitting on practice management data. So now we could do dynamic benchmarking for advisors. From dynamic benchmarking, when I joined in 2011, the reason for me coming in was to research things like, okay, how do we make better transactions, either through external M&A, or how do we actually support internal transactions, internal succession planning? That was not really done in earnest prior to 2012, really. And so when I came in, I brought a financial analysis acumen from my time in equity research, and we started modeling these transactions out, and we were giving advisors the decision of, you could seek external partners, or we could model out a long-term internal succession plan. And over the time, over those years, over the last 10 plus years, we've just continued to evolve those services. And what we're really excited about now is the amount of data that we can produce about practices. Our benchmarking continues to get better every year. It's dynamic. We're very proud of what we can do in terms of compensation design and compensation consulting. We have a tremendous amount of information around how advisors pay themselves and their team. And also we have strong opinions on how they should do those things, right? So it's a self-reinforcing business model where we can capture advisors at any stage in their life cycle, and we normally have something to say about what they're doing. So that's really how we've built FP is we want to support the independent advisor throughout that life cycle, and we continue to add products and services every 2 to 3 years. We do something new. So we're in a constant evolutionary mindset here of we want to produce better information to help advisors make better decisions.
Yeah, really value-driven consulting. I mean, we talk to firms all of the time that'll come to us and say, "Oh yeah, you're FP, you do valuations work, or you're FP, you do M&A," and the constant theme in terms of responses because there's so much more that we do. I think people have worked with us in isolation for specific projects, but we're a consulting firm. That's our North Star. That's what we lead everything with. We tell folks we help them, through the life cycle of their business, identify, grow, and realize their value. That's our focal point is helping them understand the value that they're creating, helping them grow that value, and then realizing that value through internal or external succession. So, in that's the elevator pitch of FP. And, we take on some pretty complex consulting engagements with some very large organizations, and we've got, conference rooms with whiteboards, and we'll spend a day analyzing their fact pattern. So no consulting engagement really is too small.
Yeah, it's amazing. When you talk about Eric in particular, just how much the sophistication of these transactions has changed. I think it's by the way, you guys need to trademark this. I mean, when people talk about 1 times commissionable or 2 times fee-based revenue, they're referencing the FP sort of old school model of one advisor buying another advisor's book.
Yeah, that's right.
So that's no enterprise. That's just buying the relationships. That advisor is going to sort of retire or fade off. I'm going to now own those relationships. But they are referring to the work that has been going on at FP Transitions now for over 20 years. James, I think one of the other cool things that you mentioned, and I think this is a little bit unique, is in that a lot of advisors are looking for, how do I maximize the value? And what are the steps that I need to do or take to get there? You guys will actually work with that advisor and the business well in advance of a transaction. It's not you're coming in like an investment banker. We're taking you to market. We're going to transact and we're out. In many cases, and in a few of the businesses we've been lucky enough to participate on, you've got a relationship that dates back years with that advisor.
That's a really good point. And yeah, a lot of the clients that I ultimately work with on the M&A team or for the M&A work that we do have been clients of FP for 10 years, and we've been with them through their life cycle. Also, to your point, again, our North Star is consulting. I have lots of clients come to me every year thinking they're ready to jump into, finding that partner firm. And we look at the organization and we politely tell them there are things that we need to do to get you ready. You're not ready to be a part of a larger organization or ready to go out there and find that partner. There's some things that we can do internally to your organization, to get you at a point where you are, but now's not the time. Maybe in a year from now.
Right. Building on that, James, I mean, we get this reaction almost daily. If you want to know how prepared people are to do their transaction, look at their eyes when they see the due diligence checklist after they've signed an LOI. I mean, it's 184 items that they have to check every box and they have to write a response to, and you realize, a lot of advisors aren't really prepared for that. So part of what we do is we try to tell them about the complexity that they're facing, where we can help and where they're just going to have to step up and clean up their act. Most advisors are really not, as their business stands today, ready to transact. So we do like to work with advisors, 2 to 5 years ideally before they're actually looking to sell.
And sometimes they come to us and they are ready. They understand the nuances and the complexities. So I don't want to gloss over that point. But, again, it's the fact that we lead with consulting. We're not out there to, try to fit a round peg in a square hole. It's got to be focused on being a good steward for the clients that we work with and a good steward for the industry.
You guys, Eric, you mentioned the data that you guys started like, man, now we're sitting on a lot of good data and we start to see these trends. I think, we're at kind of a unique spot too here at Carson, where now we've got a few years of data to kind of be showing where the market has been going over the last few years. It's been one of our topics we've been discussing in our weekly meeting, where we're kind of pulling up, where valuations have gone, the data we've been getting from these firms. You guys have been doing this for so long. I'm curious, those big milestones in M&A and kind of, hey, we really saw a shift here. We saw a shift here. Michael kind of alluded to the fact of the old, 2 times recurring, 1 time brokerage, and now being a little bit more sophisticated in the valuation methodology. Where have you guys seen those come from in the past, 10 years, and what's been changing in that market?
Oh, that's probably a 2-hour, monologue that I could give on the history of valuation in the industry. I would say, but I'll shorten it. I'll try to get it down to 2 minutes, and maybe 5.
Let's not be too aggressive here.
The 2 times 1 time was prevalent up until. Michael, you said it right. I mean, people still have that assumption. Mostly it's on the buy. It's mostly on the buy side that's what they want to buy practices at is the 2-in-1.
Of course, right.
But that fundamentally didn't change and I'm guessing here. It probably didn't change until about 2015, and then it's kind of been a steady drumbeat. There are a couple of major things that happened in that time period. Number one, debt financing became available prior to, and shout out to Live Oak Bank. They were really the pioneer in debt financing. Prior to Live Oak Bank actually entering the industry, debt was not done. It was done at kind of a local level, and the only way you could actually get financing is if you had a really good relationship with your banker. And
exactly.
You put,
$500,000 they typically didn't understand intangible assets or goodwill.
I can recall the number of transactions that we did prior to Live Oak on the debt side was, maybe 5 or 6, and they all took 6 to 9 months to even really get the bank to understand what was going on. So infusion of capital, right? That always that kicks things into gear and says, hey, now we can actually support higher valuations. We have lower costs of capital overall, higher potential returns. We lever up, and that's kind of been the traditional M&A model. The second thing that happened, and I'm jumping over a little bit, COVID was a major disruptor to the M&A marketplace. A couple things happened. Number one, tons of liquidity around COVID. Firms were looking for diversified returns. The market was very uncertain, and so there was a lot of private equity money that came in around that time period. It had already started prior to COVID, but I think that the major inflection point was COVID. And the other thing that happened was advisors realized that, we really hadn't had a serious sustained market disruption since, 2008, 2009, when COVID happened. It had some puts and takes throughout, but they caused advisors to really think about, how do I actually want to manage this practice going forward? And I say that because it's our belief that mentality shift of saying, hey, this is now a very frothy market. I don't know if I want to take the risk. I can actually affiliate with a larger, better capitalized partner. Instead of me just treating a transaction like I'm cashing out, I'm actually going to do a stock swap. I'm going to trade the risk in my small enterprise for risk in a larger enterprise. I'm going to take some money off the table to diversify away from my practice, but I'm still going to continue to have a role, right? So
COVID also made people think about succession. I mean, it was a scary time there back in early 2020. And we had lots of folks coming to us saying, if something happens to me, I want to make sure my team and my clients are taken care of. And I don't have that.
Right.
Yeah. And so fundamentally that mind shift caused more people who traditionally would not transact. It caused them to enter the marketplace as transactions. So you had this tremendous amount of liquidity and a bunch of new kind of underrepresented sellers. I'm going to use that term, kind of in quotes. They're not really selling. We call them mergers. So you had basically this conflagration of a tremendous amount of capital and a new class of sophisticated sellers who were looking for a longer tail on their transaction. So that trend has just continued, and we've seen private equity, the sophistication of private equity, particularly with larger organizations, and also an increased sophistication on the sell side. Sellers are asking for more. They're asking for a bigger piece of the future, and they're transacting at a younger age. So it's been really dynamic.
I completely agree with you. We actually had a conversation just yesterday about this. The days of the unsophisticated seller, I think, are over. There are so many more folks that know somebody, or are friends with somebody, are in a study group with somebody that has transacted, and their eyes have been open to what an appropriate valuation might be, or what typical deal structures might look like. or what the impact of private equity can have on a more sophisticated buyer. So I totally agree. I'll also say, I don't think it's, at least in my prior life, we saw regulation drive some of this too. So both DOL and Reg BI had certainly an impact on maybe a longer tenured advisor that was more dedicated to product and less to financial planning or true wealth management. That forced a few of those folks to consider what life might look like in a post DOL or Reg BI world.
Yeah, no doubt. No doubt. We saw that. I would say one of the trends that we're paying very close attention to is we think there's been a rebound effect on product. You know, traditionally the model always valued RIAs higher than registered reps. That's still very much the case in our experience. But what we're seeing is that firms who are not pure RIA, they're hybrid. They have the ability to place product when appropriate, and they do that ethically, responsibly, and not with high volume. What we find is that those firms are actually more profitable. So as firms get larger and we shift to that EBITDA, the metrics, they get a little confused because we're not just valuing on top line anymore. We're valuing on net profit contribution. Right. So what we've seen in our preliminary research is firms that do have insurance product are generally more profitable and they grow faster. They don't have to leave that opportunity behind.
That's right. Yeah. Why take the arrow out of the quiver if you're not forced to?
That's right.
You know, I'm a big believer in holistic wealth planning means holistic wealth planning and having access to the entire shelf. Not to say that you cannot have financial practices that are RIA only or primarily in the old BD world. And that's all that they can focus on and still be, you know, responsible and grow fast. But I think having access to alternatives when you need it, whether they're advisory or not, having access to annuities if needed, alongside all of the things that come with the advisory side of the house makes a lot of sense.
Yeah.
Go ahead, Mike.
Well, so connecting those dots a little bit, Eric and James, you kind of mentioned that switch a little bit to EBITDA and profitability, not looking much at top line. When you guys are doing your consulting engagements, you know, so yesterday we were doing our prep call for this and we joked we should have just hit record yesterday.
Yeah, the prep call was like 40 minutes. A lot of
good conversation. Yesterday, you know, a lot of that was around alignment, second generation advisors, right? So when you guys are doing your consulting, first of all, the overall shift to profitability and kind of getting them to kind of see the world the way a buyer would for their firm and how that ties into their hiring practices, succession, next gen advisors. Is that kind of a big piece? You guys mentioned, you know, having your house in order first before you're ready to sell. I would imagine that's a big part of the conversation.
It is. And I don't like to talk in terms of buyers and sellers. To me, that really is indicative of a financial transaction. And I'm not saying there's anything wrong with that mindset. There are plenty of folks that are looking for something that feels like a financial transaction because they're looking at retiring and they want to you know, retain the value of what they've built. But we really love when we get to talk in terms of partnership, when we really get to, you know, have a session with a client where we're really understanding, you know, what keeps them up at night. You know, is it the back office work? Is it compliance? Is it the regulatory structures that they're having to navigate? Is it, you know, is it the turbulence in the market? What is it that's keeping you up at night? Why are we talking? You know, you didn't decide to pick up the phone one day and reach out to FP and talk about M&A. There's a reason there, and it's really important for us to understand that reason, because that's what creates the right partnership for that organization. The partnership that they create needs to solve for those pain points, and not everybody's pain points are the same. I also like to talk in terms of stakeholder groups, meaning we're typically talking to a founder. They're a stakeholder, and any partners they have, of course, are a stakeholder as well. But there's other stakeholders in creating a partnership. You've got the team that backs those partners in the organization. Could be advisors, could be support staff, whoever they are a stakeholder in any partnership that is created as well. It's got to be a partnership that is beneficial for that group, meaning, you know, you can't come into an organization that's got tenure together and start, you know, picking and choosing who you're going to allow to join the new partnership. You've got to provide opportunities for those folks. And opportunity needs to be career advancement. It needs to be opportunities that those folks are excited about. So really understanding the team and what drives them and what excites them and what their career goals is also important. And then the final kind of stakeholder group on that side of the ledger are the clients. You can't, partner with a firm who's going to be disruptive to the client relationship or disrupt the story that you've told.
Yeah.
Meaning, if you have been with these clients and told them the benefit of, fee only practice, it's going to be hard to shift that mentality. You can't partner with a firm that says, you know what, everything Mike and Michael have told you for the last 20 years, not wrong, but not completely right. We're going to shift it. We're going to do things differently. And this is how it's going to be going forward. The clients are going to look at that and say, time out. This isn't what I signed up for. So, it needs to be alignment from the offerings to the clients. And many times it needs to be additive services. I mean, a lot of the firms out there are, surrounding the client relationships with, trust offerings, more detailed estate work and all of tax prep and all of these things that a smaller firm may not be able to offer their clients, but certainly could be an added benefit. So, we see the conversation around that. And I love when we get to really paint that picture of what partnership looks like, focusing on those stakeholder groups.
Yeah. I love that you kind of framed it that way on the partnership instead of buy sell. Do you think one data point we've been seeing is that the average age of that founder coming to the table wanting to have those conversations is actually coming down a bit?
Yeah.
And so in that manner, it becomes less and less about that typical financial transaction at the end of a career, where, culture and team fit and all of those, sometimes is undervalued. Whereas now these founders are coming to the table, right? Early 40s, firms still in that middle growth phase that still has a lot of upside potential. And so I think you're right. Is that like that partnership conversation becomes even that much more important if this conversation is being had earlier rather than later?
Especially when there's a second generation involved, Mike.
Yeah, I was working with an advisor a couple of months ago who loved what they were doing, but they were tired of being the only one making decisions. Had a great firm, had great staff, great clients, but the buck stopped with them, and they used to be part of a partnership, and they wanted that again. Every day it was decisions that they were having to make without anyone to go to talk through these decisions in terms of right path. So they were a younger advisor, kind of in their 40s, and we found them on a partner that they're super excited about. Things are going really well. So, those are the stories, Mike, that I love talking about. And I love being that consultative guide for those types of partnership creations.
Hey, James, let's talk about a real life one. So Nate Fisher and Tim Fisher, we worked on together. Now Carson Wealth Hanover, they're an amazing group. I count Nate as a personal friend of mine now, but early in the conversation, so this is a terrific firm, smaller town, Hanover, New Hampshire. Tim is the founder. Yep. Nate is his son. And then Diane, super talented operations staff that now is moving into more of an advisor role. But during that conversation, Tim had said, being an independent RIA, running my own firm can be lonely. Like he has had the experience of working with a partnership or at a larger firm. His son, Nate, had not had that opportunity. So in that conversation, it was, this isn't just for me. It's to create that community so that when I retire, Nate's got a backstop and Nate's got a team and friends and people he can go to talk about how they're doing financial planning or what's working and what's not working, so that he doesn't feel like he's out on an island by himself all the time. And that was really compelling to hear as part of that discovery process.
Yeah, great group. And I love that you use the word community. That's something that I talk about all the time. You got to find your tribe. You got to find your community, and there's optionality out there. That's one thing that, we talked about the maturing of our industry. One thing that the maturing of this industry and the sophistication that's allowed for in deal terms and the M&A environment is you can be very prescriptive in terms of what you're looking for in your tribe and your community. It's not a one size fits all. There's a lot of diversification out there. So, for the firms that I talk with all the time, have this idea of what partnership looks like. And I love educating them on a mind shift and saying, what you thought was a partnership does exist, but there's so many other variabilities, and you really get to be nuanced in your partnership search. I love going through a list of criteria and saying, none of that is of a concern given the maturity of the space that we're working within now.
Yeah, you can find a flavor for everything.
Yeah.
And where we see a tremendous amount of variation in that conversation is what people view as their highest and best use, right?
Mm-hmm.
An individual, for example, why would someone engage in M&A at age 50 when they still have, some of them quote, I want to work for the next 25 years. We talk to them and we assess kind of their strategy, their growth strategy. We try to understand through our benchmarking, what steps are you going to have to take? And it's very common for an advisor, particularly, young, aggressive advisors, to say, look, I'm at 250 million right now, and I want to grow to $1 billion in AUM, and I wouldn't consider transacting until we get there. And when we stress test them on that, we say, look, you need this X% growth rate per year. You've got one support staff, no other advisors who are helping you, so you're going to have to hire 3 to 4 more advisors. You're going to have an organic growth strategy, which involves marketing, which involves a completely different acumen that you don't necessarily possess today. And we say, are you really prepared to shift from someone who has built their practice on deep client relationships, and now you're going to go into what is effectively a management role? And a lot of them, they just kind of assume that the growth is going to happen and they're not going to have to go through that mind shift. And so when we present them with that and we say, look, what you really want to do is make hay, then go do that. Let your partner firm handle the back office. Let them handle the hiring and firing. You have control over what you want to have control over. You say, bring me resumes for 10 advisors and I'm going to hire one. You get to pick that one, but you don't have to do all the legwork. You don't have to do all that other stuff. So you go back to doing what you got into the industry to do, right? There are very few advisors in our view who will successfully make that shift. And I'm talking about globally across the hundreds of thousands of advisors. Most of them, they really just want to work with clients, do a good job, enjoy, the deep community relationships that they get, and they don't want the headaches of human resources or technology.
Yeah, so I don't think a single time no advisor has ever sat in our office and said, I really want to keep compliance. I really want to keep resources.
I've had a couple say that they love compliance, but it's a rare breed.
Freaks.
Yeah.
So, I think what Eric is talking about, it's a good point. It's we get to build the plan for the planners. We get to highlight what they need to do to go from where they are to where they want to be, just like our clients do with their end user clients. They come in, they build a plan, they have a client that tells them where they want to be in terms of retirement, and they get to say, here are the dials and the knobs you get to turn to get there. Sometimes you got to be a little bit more aggressive. Sometimes, we're here to tell you can't actually reach where you want to be unless there are significant changes in what you're doing in terms of savings or earning. So that's the visibility we have. We love giving that guidance, and some people are right on track. They come to us, we do a little tweaking here and there. We build that plan. We show what they need to be doing. We show what the firm needs to be doing over the next 5 years to get there. But again, sometimes those dials need to be turned a little bit more aggressively than is a reality of what their ultimate outcome is.
So let's shift gears here for a moment. Let's see, this is Thursday, April 10th at 11:30 Central. I don't know if you guys know this, but the markets have been a little bit crazy the last few days. Things have been happening.
I heard. Yeah. What did I miss?
Somewhere. Let's prognosticate any impact on the M&A market. How do you see this playing out? And I know this is a fool's errand, but for the next 6 months to 12 months, what do you guys see? And then Mike and I are strong in our opinions as well.
I'm gonna hedge a little and say, rather than answer that question directly, I'm gonna answer it indirectly. What did we see the last time this happened? That we had severe market volatility and turbulence? We didn't see pullbacks at all.
Right.
What we saw was the buy side being more discerning. You know, they moved to quality, and they said, look, we're only going to engage in M&A for firms that have the best fit. We're going to reserve our capital for firms that we know are going to be long-term contributors to our growth strategy. So, and that's a trend that we've actually seen since COVID. Is we've seen, you know, we still have tremendous interest, but when it gets time to get to the LOI phase, we're seeing the firms that actually represent the best fit are putting the strongest financial offer in place. And at the largest size of the deals that we work on, the billion plus size deals, the spread between those offers might be 20% in terms of total economics. So what we see is that firms are paying for fit. So when we think about that in context of the previous market volatility that we've seen, we think that the buy side is going to continue to be discerning, but they're not going to reduce their interest in M&A wholly. So they'll be more specific. They're going to be targeting firms that represent the best cultural fit. I will also point out of the 45 James deals that we have in process, none of them have pulled out. None of them have said we need to renegotiate our LOI. So and again, that's a reflection of finding that best cultural fit, finding firms that say, look, we're really looking at this from a long-term view. What would you tell your clients? Would you tell your clients to panic sell or panic buy anything right now? No, stick to the plan. These are long-term investments. We need to take that view. And maybe we make some adjustments on the deal structure to cover, you know, catastrophic downside. But that's almost always counteracted by, if the market recovers, we can get that back in the deal, right? So through creative deal making, we can still maintain a high degree of momentum with well-qualified buyers and sellers.
Through recapturing mechanisms. I go back to the commentary we had earlier. These are long-term partnerships that are being created. You're not going to let, you know, current short-term economic volatility disrupt the creation of a long-term partnership on either side.
I think it's important to note too, this isn't ancient history. I mean, 2022, we saw a down market and certainly volatility. And we missed setting a record by 4 transactions, depending on the source you look at. So the market didn't blink. I think it depends is the best way I would answer the question. I think there are macro reasons why I am confident that we've got at least a 10-year bull market in M&A transactions. Certainly, if the volatility is extreme and continues unabated for the next 12 months, that's going to have some level of impact. But I think more often than not, and I think, Mike, you'd agree, I'm going to quote Laura Delaney, our friend at Fidelity here, you know, M&A is not a market timing activity. There are, when you take a programmatic approach to this is all going to work out in the long run. We're still solving specific problems for specific advisors. And as long as that's the approach that you're going to take, we are going to be as aggressive and as acquisitive as we were last year, and we will be next year, regardless of what's happening in the market.
I also want to point out that the way these deals that are structured for a long-term partnership, again, going back to one of the trends that we see continue to persist, is the existence of equity in the deal. The rising tide floats all boats, right? So when we're swapping equity, the price impact, it's not always 1-to-1, but it's pretty close, right? So when we're swapping stock, you're not necessarily taking a discount on that swap. So it increases the importance of doing due diligence on both the buy and sell side to figure out, what is that exchange rate on that equity? Does it still make sense? But fundamentally, what we're actually trying to do is, through these transactions, reduce the operating risk for the selling advisor. And that doesn't really have a whole lot to do with the macroeconomic environment, provided that the buy side is not over levered.
And I think there's an element too of when you go through these times, like, number one, sometimes I think for an individual who was already thinking about coming to the table, it might accelerate things a little bit. But going back to James, what you said about partnership, okay, now that I'm going through another one of these, which of these partnerships can really help me during these times? You know, a quick example of that is Brian Dietrich and Sonu from our investments team worked overnight all weekend and then had an all-call partner on Monday on, here's what we're seeing. Here are some things on how you can address it with your clients, right? What are those extra little things that your partner can do for you that makes times like these a little bit easier, right? And for all of our advisors, it's, how am I going to handle the influx of phone calls I'm getting from clients right now? What do we have in terms of, you know, market projections or historical facts that we can pull from to have speaking points? It's those sort of little things that are going to be differentiators now that you can kind of point to that say, hey, like our partnership, we're here for you in this area or this area, right? Compliance is always those in technology, but now you kind of
that's the low hanging fruit, right? Areas. Everybody does compliance and back office.
Yeah,
stuff.
It's the table stakes.
It's the other Ryan and Sonu, right? Like who's going to be, grinding and burn the midnight oil, right? To kind of help you with those conversations that you're having.
Yeah, I had a call on Friday afternoon. Trey Wiltsey, one of our advisors down in Kansas City, called me late on Friday. He's another friend of mine now. We were just chatting, and he said, times like this, he said, this is when I show my value to the clients. Like, this is when I go on offense. Like, this is I call my clients proactively. I'm having conversations around what we're doing and why we take the long-term approach, and having a partner like Carson that is generating that content that Mike was just talking about certainly makes that conversation a little bit smoother than having to create that on your own or rely on like a third-party service. So
to your point, it allows them to focus on what matters during turbulence, and that's communicating with the client, as opposed to having to communicate with the client, craft content so that they know what they're communicating with the client, and all of the other day-to-day tasks that they would have to have burdening them, taking away from the time. I mean, folks come to us, daily talking about what life used to look like for them when they were starting their career and they got to spend time with their clients. And now they're burdened with this idea of spending, 50, 60% of their day on the business. And they've loved doing that. And they've loved building what they've built. When they turn around and look, it's surprising to most folks, but in the remainder of their time in their organization, they don't want to keep spending 60% on the operation. They want to spend their twilight or their glide path to retirement on how they started, which is those client relationships.
Yeah. I mean, that's where you get to mine the A clients, when you take off all those other hats that nobody wants to be wearing.
Yep.
Except for those few oddballs you mentioned earlier.
And nobody typically wants their transaction to be a light switch, meaning they don't want to transact on Friday and be retired on Monday. They don't feel that's fair to their team, to their clients, to their other partners. And I agree with that. It needs to be a transition, and it needs to be a strategically planned glide path.
Well, actually, this is another, I guess, copyright for you guys. Sell and stay is your thing. I mean, that we all use it now, but that's another FP-ism.
That's trademarked, I think.
It is trademarked.
Yeah, and it's remarkable because how many times, Mike, you too, how many times do you see a transaction that's not a sell and stay anymore? Never.
Very
rarely.
Almost never. Yeah,
it's pretty rare.
We
still have clients that want to do that, meaning they're ready to transact and they're ready to retire with a shorter time period, 6, 8, 9 months, 12 months to they're out. But yeah, it's a great point. People don't feel like, and rightfully so, that they can just cold turkey retire from this industry. These are relationships they've had for a number of years, sometimes 20, 30, and they don't want to just leave that relationship. They feel they've got to be a good steward and slowly transition those relationships to someone that they're comfortable with.
That's what I love about this business, though. It is so personal. There was an advisor we were speaking with last year that he was relaying this. He goes, I've been working with these clients for 40 years. And my dad, who was a CPA, worked for these clients or with a lot of these clients prior to me ever getting into the business. He said, no matter whether I'm registered or not, I will be golfing with and hanging out with my clients until the day I die.
Yeah,
that's right.
So for me, working with my sort of top 20, that's not work. These are my best friends. These people I've known my entire life.
It's part of the reason why it's part of the reason why a lot of advisors never retire, right? And there are negative implications of that. Just so we're very clear, working with your top 20, right. you can't golf with 200 clients, right?
No.
Maybe some people can, but there are other implications, and that's one of the things that we talk about is really what do you want to be doing? And they say, well, really, I'd like to work with friends and family, and everything else I can delegate. And so I'm looking for a partner who can help me do that. Very common fact pattern.
Yeah. And it's why M&A in different industries is much different. I mean, if you're doing M&A for widgets, you don't have that personal relationship that you're transitioning to someone else. So, those are much more transactional in basis, which is why again, going back to the commentary on partnership, it matters a lot more in this space than it does any other industry in terms of real assets.
Yeah. Well, guys, this has been terrific. We are, as we estimated, we're already at 45 minutes. So let's do like a lightning round here. Any big, bold, crazy predictions for the next, you call the timeline, 12 months to 5 years?
James, you go first.
Michael, I agree with your commentary. I think M&A is still going strong and will be. There's a lot of firms out there that are looking for that partner. And again, we're talking to them every day, and just looking forward to continuing to help that. I mean, there's certainly been some news stories recently with LPL and Commonwealth that have provided for some interesting commentary out there. But we'll see where we'll see where all of that ends up.
Amazing. We didn't even get to that. We spent some time on that yesterday. We didn't even get to that today. Eric, you're up.
I think valuations are going to continue to be highly varied. I think price discovery is something that we've kind of figured out in the industry, and people want to reduce it down to a single number. And I think the reality is that the spread between the best managed practices and the average practices is going to continue to increase, with the buy side focusing on firms that add substantial long-term value, and they'll pay extra for that. So I do think that, using average multiples as a yardstick for overall M&A is going to be a fraught exercise, and I think there's going to be a high degree of specificity related to your own internal practice management and how that's viewed by one buyer or another. I think there's going to be substantial price differences related to fit and internal operations.
Yeah, I couldn't agree more. I think it should be a shock to nobody when we talk about the best firms we've seen and maybe the least valued firms we've seen. There can be a 10x EBITDA difference between those two firms. Yeah. So to use a median or an average, I agree, Eric. I think that's dangerous.
And I think one thing we'll see, just to give my final thoughts, we're going to see firms looking for less prescriptive partners, meaning, we don't want to fit within this box that you've defined as to what you think a partnership is. We've got to be a little more creative and design partnerships that are tailored to the firm that you're looking to have partner with your organization. So I'm always a big proponent of, being open to partnering with someone that makes sense. I mean, you don't want to go outside of the confines of what you're comfortable with, but you've got to be open to differentiated structures, because the prescriptive way of doing M&A, isn't going to withstand volatility.
No, we're winning on flexibility right now. Burt White was having a conversation with a prospective seller in here, a week ago, talking about our goal is to find really great entrepreneurs and keep them as entrepreneurs, not suck the soul out of what made them successful.
Yeah, you've got to be focused on that flexibility and entrepreneurship. Yeah. And that's one of the biggest concerns when I talk to people is, how is my life going to change? Are they going to, make me punch a proverbial time clock when I show up in the morning? And am I going to lose that entrepreneurial spirit? And if that is the message, if it's overly prescriptive, if it's too conforming to a process, that doesn't resonate well with someone who's looking for a partner.
And Michael, one closing comment. We could just let's just do it again next week.
Round one, right?
Yeah. People don't know that we're going to stop recording and probably stay on the phone for another 30 minutes.
Well, I just wanted to shout out to both you and Mike and leadership at Carson. Having that flexible platform is not something that Carson was known for 7-8 years ago, right? And so I think that you guys have adapted to the industry, and you've said advisors, they want choice, and you can't have so much choice that it becomes unmanageable and undifferentiated. But you have to understand where the guideposts are there, where you can allow advisors to be flexible and still make your return for all of your investors at the corporate level as well. So credit to you and leadership at Carson. You've done a fantastic job appealing to that mindset.
Well, thank the two of you. Thank you for the partnership with FP Transitions. You guys are vanguards in this space. We're proud to work alongside you. And thanks for appearing on Know Your Worth. I'm sure we're going to have you guys back.
Awesome.
Thanks,
Looking
both of you.
forward to it.
All right. Hey,
to both
special
of you.
thanks to Tori Renwick, our producer on this. And Mike and I will see you next month. Thanks for joining.